Boa noite, senhoras e senhores. Tudo bem com vocês? Bom, hoje é um dia especial aqui. Trouxe um camarada sensacional, um cara fantástico, um cara que eu admiro demais, principalmente não só falando de mercado de opções, mas falando como disciplina, motivação, dia a dia. É um cara fantástico que eu tenho o maior prazer de trazer aqui para vocês. É um cara que eu tenho certeza que vai agregar muito no nosso conhecimento aqui. Eu tenho certeza que vocês vão gostar bastante de tudo que a gente vai falar por aqui. Vou deixar claro aqui, pessoal, que a gente vai botar as legendas, tá? Daqui uns 2 dias, mais ou menos, a gente repõe, a gente refaz o vídeo colocando as legendas para quem quiser depois assistir posteriormente, tá bom? A gente vai bater um papo muito bacana aqui, eu e o Jim, falar tudo que eu acho necessário e pertinente sobre o mercado de opções. Eu tenho certeza que vocês vão gostar demais, beleza? Bom, vamos lá, galera. Hey, Jim, how you doing?
I'm good, man. How are you doing? I'm doing really good. How you doing?
I'm great, man. I'm great. Well, man, first of all, I want to thank you one more time for being here with us. It's a pleasure again to have you here with us. I know we have a lot of things to do all the time, but got some time for us, and it's really great to have you here. All right. So first of all, I want you to introduce yourself, tell a little bit about yourself, your background, how you got into options, how you got into Taste to Works, Taste Live, and everything that you do right now.
Yeah, so yeah, it's my pleasure to be here. I'm really excited to be with you again, Junior. We had such a good time the first time that we connected on air and during the webinar and stuff. It was great. So I was very excited when you invited me back and we had a chance to do this again. So I'm really pumped to be able to kind of help your audience in any way that I can. So my career, kind of took an interesting turn when I met Tom Sosnoff, who of course is the CEO of Tasty Trade and Tasty Live and, Tasty, I mean, all those things, right? The Tasty brand. And so before I joined Tasty Live, I was working as a professor at a small university in South Carolina, and I was teaching undergraduate classes. I was teaching MBA classes. I had finished all of my schooling, undergrad, MBA, PhD, straight through 10 years. And I couldn't wait. I couldn't wait to teach. I couldn't wait to be in front of students and just kind of talk about trading and talk about investing and talk about portfolio management and all those things. And then I met Tom, and my career took a pretty surprising turn in terms of being able to join what they were doing. I mean, this was I've been with Tasty now for 7 years, so this was 7 years ago, and so it was an incredible opportunity for me personally and professionally to be able to join the network and have my own show and communicate with so many traders live. I mean, one of the biggest changes for me, Junior, that was really quite a challenge and still is to this day, was I was used to teaching and I was used to instructing and I was used to helping people learn, but it's very different, as I'm sure you can appreciate, when you've got a room full of students who are, they want to learn the material, but they want to learn the material to pass the class, which is good. But now all of a sudden, I was talking to actual traders every single day with actual money on the line every single day. 5 figures, 6 figures, 7 figures, 8 figures. I mean, some people had huge, massive portfolios. And so it really challenged me and still does to this day. I'm like, all right, man, I've really got to know my stuff to the best of my ability. And I've got to be humble enough to say, if I don't know, I don't know. Like, I can't have people making real time decisions with real money based off of something that I might say or do or show and not feel supremely confident in what I'm doing. So it's been an amazing journey. I feel so grateful and blessed to have been on this journey so far. And so that brings me here on, January 16th, 2023 with you all. So I'm excited, man.
Man, that's great. That's great when you say it because if you think about it, you can see that now. I mean, even in Brazil, we have now a lot of students which they want to learn how to trade options in the American marketplace, and it's amazing, Jim. It's amazing because I used to talk to them that when I like 10 years ago for me, 10 years ago, I was trading options by myself. I was studying options by myself. You were one of the guys that was studying back then, like 5, 6 years ago. And right now, a lot of people want to learn the things that I'm doing in the American marketplace. A lot of Brazilian people, and it's really exciting for me, as I know that's really exciting for you too. So it's great, man. It's really great, and it's really I'll say it again, it's really a pleasure. Okay, so let's go
Yeah, I'm
into it.
excited here, man. Yeah.
All right. First thing I want to ask you. Well, we just got into the new year, 2023. 2022 was crazy volatility going up and down all the time. But right now, we're seeing low volatility. I mean, VIX is around 18, 19. It's not that good for us. It's kind of boring. But what are you feeling about 2023? How do you feel about it? What do you think is going I know you don't have like a crystal ball, something like that, but how do you think it's going to be the whole thing, the whole year?
Yep. Yeah. So great question. And yes, and I don't have a crystal ball. Neither does anyone else. Nobody really knows, but it's always fun. It's fun to have an opinion. It's fun to have a, some type of bias. And so I'm definitely going to share mine. I have no problem with that whatsoever. And so I think that, so a couple of things. Number one, if you look back historically at the VIX, we have to make sure that we contextualize the VIX appropriately. And so VIX at 18 or 19, that's around the historical average. It's actually still a little bit higher than the historical average. Historical average is around 16 or 17. And so it's still a little bit higher. It's still, but it's not great relative to what we just came off of in 2022. 2022 was such a rich environment for premium sellers and high volatility traders, which is what we are. So, it can be difficult to kind of say, oh man, like there's nothing going on. It's like, no, it's not like it was last year, but it's still, I mean, I'm sure you remember, Junior. I mean, 2017, 2018, I mean, the VIX was like 9, 10. I mean, that was really, really difficult. But then the other thing that I'll say is I have a really hard time believing that the market is just going to take off from here and never look back. I would be very surprised. Now, the market is very good at making people be very, very surprised. So it could happen, but I'd be very surprised if we don't retest the lows from last year or maybe even put in new lows because the Fed is still raising interest rates. Everybody's hoping they're going to pivot. There's just no way they can pivot. There's absolutely no way they can pivot unless something catastrophic happens. Jerome Powell, if he wants to maintain any credibility, he has to stay the course. It doesn't mean that he can't slow down, and it doesn't mean that he can't pause, but I don't think he can. I don't think he can reverse course. And I think that maybe a lot of people are thinking that he might do that later on this year. I just don't think I don't see that in the cards. And so, I could see us rallying this year and finishing higher on the close, but the pathway to get there, I think is going to be bumpy. I personally think we're going to go down again this year. And I think we could, finish the year even lower than where we are now or where we finished last year. But I see us probably testing some low or pricing in a new low of 3,000, 3,100, 3,200 on the S&P 500. That would not surprise me at all.
Yeah, man, because I think it's just too weird that volatility is too low right now. It's not. I mean, it would not be the right time for the volatility to be around 18, 19. I don't know. I think it's weird. It's kind of weird for the last year. From the last year, if you look from the perspective from the last year, it is kind of weird for me right now. The VIX around 18, 19. But anyways, well,
Mhm.
so right now we're going through a low volatility environment, and volatility we know, of course, that it's primary to know how exposed we can get when we talk about trading options, right? So how do you evaluate it? How do you expose yourself in this kind of environment?
So do you mean like what types of strategies I look for? Like how do I handle lower volatility?
Yes. How do you handle it? Like strategies, you sell premium sometimes, you don't, you buy premium. How do you sell? How do you work with that?
Yeah, yeah. So that's a great question. So a couple of thoughts. So number one, right? Obviously, as we saw last year, and in any environment when volatility is higher, and the tasted research has shown this over and over again, it's just so much more effective for what we're doing as premium sellers. So when the VIX is 25 or 30 or 35, it's just going to be a lot better for us, pretty much across the board. That being said, short premium just as an overall strategy, whether it be selling strangles, whether it be selling puts, whether it be doing ratio spreads, whatever, especially undefined risk premium, which I'm sure we're going to talk about that in a bit too. But when it comes to short premium, just in general, it's so effective. It is so good. It even works when volatility is lower. So even with the VIX at 18, 19, I would not be afraid to have some short premium working for you. I have short premium working for me. And so I don't think you should, put all of your capital to use. I don't think now's the time to allocate all of your capital. I would probably, so for example, to give your audience some like hard and fast numbers, let's say let's say you have a $30,000 portfolio, or let's say you have $50,000 and you like to normally have 50% allocated. So usually you have 25% or usually you have 25,000 allocated on average most of the time. Maybe right now you only allocate 10,000 or 12,000. So like 25% of your portfolio. And you can scale that if you have more money or less money or whatever. Most traders that we come in contact with are somewhere around 30 to 80,000, let's say, in terms of their account size. And so I would say, hey, allocate 25% of your capital to mostly short premium because it's still going to be effective. And one of the things that we learned, Junior, recently is volatility can remain low for a very, very, very long time. And so it can be really challenging to stay on the sidelines for, 3 months, 6 months, 9 months, 12 months, all those things. When you have, return projections you're trying to hit, you want theta working for you, you want your capital, working for you, all these things. And so I wouldn't be afraid to sell some premium because it still works when volatility is low. You just have to make sure that you don't allocate all of your capital for two reasons. Number one, you don't want to get caught in a volatility spike when all your capital is already allocated. Because what that's going to do is A, your current positions are going to get hurt and they might get hurt badly. But also B, if you've allocated all of your capital, you don't have any ammunition. You don't have any powder dry on the sidelines to now take advantage of the VIX being higher. And so I think a strategic way to do this is still sell some premium, but just be really thoughtful about it. Be very patient, be very methodical. Don't feel like it's a rush. Don't feel like you have to act urgently and just kind of wait for the VIX to spike because we know it'll spike. We just don't know when it's going to spike. And then, of course, if you want to buy some, vertical spreads or buy some diagonal spreads or some calendar spreads, you could do that too. But I wouldn't totally dismiss short premium.
Nice, nice, man. There was a question about it, but already got it answered.
Okay. Yeah, and people who are watching, if there are questions that come in, please put them in, send them in the chat, send them to Junior, whatever. I got plenty of time, so let's do it.
All right, man. Yeah, I'll be talking to them. Pessoal, se vocês tiverem qualquer pergunta pro Jim, ele tá falando isso agora, bota aqui pra gente, tá? Que eu traduzo para vocês e a gente passa para ele. Aí depois eu traduzo a resposta para vocês também, se vocês quiserem, beleza? So, Jim, we have something in common. We are permables. And of course, we are premium sellers. But especially when we talk about selling puts. I love selling puts, man. I do it all the time, like you do. But sometimes it goes against us. It's normal. It's part of the game. It happens all the time. I mean, not all the time, but it happens. But how do you manage like naked puts, like short puts? How do you manage them?
It's a great question. It's an excellent question. So, can you bring up my screen now? Let me show everybody.
No,
So,
man.
I'm inside of my platform. So, I'm just inside of my Tastyworks platform, and let me bring up IWM here really quick because it's a little bit of a lower priced index. I mean, this is the Russell 2000, and this will be within reach for a lot of people that might be watching this stream. So, I mean, we could look at the Qs or SPY too, but I think IWM might be a really, really good fit. So, let's say I went into March and let's just say I went right to like like a 30 delta, option. So I'd sell like this 179 put right here. So you can see right there, it's 30 deltas. I'm selling it for $3.42. So of course the max loss is 17,558. That would only happen if IWM went to zero. Now, theoretically, can IWM go to zero? Yes. Practically, is IWM going to go to zero? No, it's not even going to come close. And so it's important to understand where these numbers are coming from. And so that is a theoretical possibility, but it's not going to be a practical reality where the stock market quite literally goes to zero. And so I want to make sure I mention that for people that might be new watching this saying, whoa, man, like I can't handle a loss of $17,000. Like I understand that that's not going to happen in one of the equity indexes. But here's what's great about this situation. If you look at the current price of IWM is up at 187. So if I sell this 179 put, just to make sure everyone understands how this strategy works, if IWM stays above 179, it could even go down a little bit. It could stay where it is at 187. It could go up to 190, 200, whatever. I'm going to keep this $3.42. So I'm going to keep that. I'm going to put it in my back pocket. And of course, it's multiplied by 100 because there's 100 shares in every option contract. So that's where this max profit of 342 comes from. So, okay, that's all easy. That's all strawberries. That's all sunshine. Everybody's happy. No big problems there. What happens when IWM goes down? So now let's say IWM goes down to, 179 or 175 or 170. There's a couple different things that you could do here. And it really depends on how you view this position. And this is a question that I answer on a very, very regular basis. There are some people that want to be in the markets, they want to be super active, they want to, they want to zig, they want to zag, they want to do all these things every single day. And that's what we teach people how to do at Tasty. I mean, that's what I show people how to do on my show, From Theory to Practice. And I think there's a ton of merit and there's a ton of potential in that strategy where, you're rolling out in time, you're adding calls, you're minimizing directional risk, all those things. And we can talk about all those things. But I want to give people an even simpler approach. So one of the things that you can do, let's say that IWM goes to, 170. One of the things that I can do is I can stay at this 179 strike if I want to. I can just stay right there and I can do one of two things. Number one, I could just let the option get assigned and I would have to buy IWM at 179. Now look at how powerful this is. And this is really where the whole perma bull thing comes into play. Since you brought that up, I kind of wanted to mention this as an option. If you have a bullish view on the overall market long term, you have an incredible advantage in the market, in my opinion, because let's say IWM goes down. Let's say volatility spikes and the market doesn't like, the next Fed announcement or whatever the reason might be. Volatility spikes, the market goes down to 170 IWM. You take assignment at 179, which by the way is lower than IWM is right here at 187. So you've already gotten a discount on the price from where you would have purchased it today. But now you can just hold those shares at 179 for as long as you want to. And you could turn it into a covered call. You could sell premium against it. There's a million things that you can do. And because you are a perma bull, you don't mind owning shares in the equity indexes long term. And again, that's so advantageous. So advantageous. If you play the market from the short side, if you play the market from a bearish, standpoint, which has its own benefits and its own pros and its own, advantages to it, this is one of the things that you really don't want to do. And in a market that wants to go higher over time and a stock market that wants to rise over time, I really feel like you're making it a bit harder on yourself, to be perfectly honest. And so that's a very simple approach. And again, on Tasty, we talk about so many other strategies. And so I kind of wanted to give your audience a little something different here. And so, for somebody that wants to be a bit more active, they can check out Tasty, they can check out From Theory to Practice. I mean, you can just Google, if you Google From Theory to Practice, Tasty trade, short puts, I mean, you'll probably find 20 different segments I've done on this. So I can show anybody a number of different ways that you could do this.
That's great, man. That's great. Well, and it's awesome because, well, I remember that when I first started trading options in the American marketplace, first time I met in the Tasty Live platform, it was Mike. He was the first guy because he was in the basic videos and stuff like that. And after that, I met you. Okay, this guy is a little bit more technical. I'm going to go this way. So it's really amazing, all the content and all the educational videos that you guys have on the platform. I believe that everyone who really wants to learn how to trade options really should watch it. I mean, it's a demand. They have to, and it's really great. Your shows are really great, Jim. You know that, right?
Thank you, man. That's awesome. Thank you.
We're gonna be talking about it a little bit further because I'm gonna be talking about, when we talk about the Greeks, we're gonna be talking about your options Greeks 101. That I really like that show. We're gonna be talking about it. But let me ask you something before. Do you have like a checklist or a trade plan for getting into trade, something like that? Can you tell us a little bit about it?
Yeah. So that's a really good question too. And we'll stay in my platform here so I can kind of show everybody exactly. So the first thing that I'll do is and you can see this is my portfolio that I'm working with on the show currently. Not very many positions. Hey, I've got EWZ for all you guys out there. So there you go. Right. There you go. Right. Yeah. So I only have a few positions on right now because I kind of cleaned some things up at the end of 2022 and started 2023 without too many positions. So the first thing that I'll want to look at is, okay, what do I have working in my portfolio right now? And so what do I have in my portfolio right now? What do I think I need to add to complement what I have in the portfolio right now? And so a lot of times, I'll look at what I have in my current portfolio. I might pull down, my overall portfolio metrics, you can see we're down a little bit on the year so far, but it's early, so that's good. We got plenty of time, to make that back. My theta is a little bit positive. That's good. My delta is a little bit negative. That's also kind of fitting with where I think the market might go this year. I am a perma bull, but I am going to play it from the short side a little bit this year just to make Tom happy because Tom likes he likes playing it from the short side. So now at least we're on the same page. And so when I look at this, you look at like your overall theta numbers, that shows me that I'm a little bit low on my theta. I'd like that number to be closer to 20. And so this can be very informative for everyone that's watching the stream here tonight. Use your portfolio metrics, delta and theta, to guide you where you want to go next. And so if you have theta goals and you have delta goals, which we can talk about those if you want to, but if you have delta goals and theta goals, then it's like, all right, once you have those numbers in place, then the decisions you make underneath that at the individual stock level, at the position level, etc., they become a lot easier to make. And so, like right now, for example, I look at my theta number and I'm like, okay, that's only 5. So that's very, very low. So that helps me realize, okay, I want to sell some premium. I want to get some premium out there. But again, the VIX is lower. So maybe I don't try to get all the way to 20. Maybe I'm okay just getting to 12 or 13 or 14 right now because I'm only working with 20,000 in this account. So, this is a fairly small account in the world of trading. And so, but still, a theta of 5 is probably not enough, right? A theta of 5 is probably not enough to K working for me. So, okay, I definitely want to sell some premium. All right. The next thing I want to think about is what type of strategy do I want to use to sell that premium? Well, since my theta is only 5, I kind of want to build up some theta quickly. And so that's going to push me to an undefined risk strategy as opposed to a defined risk strategy. So I might do a strangle, I might do a short put, I might do a ratio spread. Whereas if I was going to do something defined risk, maybe I do a vertical spread, maybe I do an iron condor. And again, this theta is going to help me. So naturally, if I was watching this stream, one question that I would have at this time would be, all right, Jim, you're looking at a theta of 5 and you've determined that undefined risk is a better option for you right now. What would that number need to be for you to determine that maybe defined risk would be a better option? That'd be a very good question to have at this time. If my theta was like 15 or 12 or 13, a little closer to where I want it to be, but I kind of wanted to stay active, I kind of wanted to get a little bit more capital working for me, that's when I might go to a vertical spread, an iron condor, or something like that. So then the next thing that I'll do once I look at those numbers is I'll go to this little menu right here. I'll leave my cursor on there so you guys can see it. And I'll go to the different watch lists that we have at Tasty. And you click on the watch list. And then if you go up here to this drop down menu, there's all kinds of different ones that you can choose in all kinds of different categories. There's the Tasty category, there's the crypto category, there's the dividend category, etc. You go all the way down the list. Well, my two favorites are the Tasty default watch list and then Tom's watch list. And so these are basically going to be all the stocks that you see us trade every single day. And that's what we want to do. We want to stay in the stocks that everybody trades. We want to stay in the stocks that are very high liquidity. We don't really want to be trying to find some, very unique, very, off the beaten path stock that nobody's ever heard of and try to strike a rich. We would much prefer to sell, premium in Apple, Netflix, Amazon, Tesla, IBM, stocks like that. So if I go into the Tasty default watch list, I already know that I want to sell some premium based on my metrics. I already know that I want this to be undefined risk based on the fact that my theta is a bit lower. I also know because my delta is a little bit negative, right? You can see it is a little bit negative. That's what I want. So now I'm kind of thinking, all right, I probably want something that's a little bit neutral, right? I don't really need the bullish delta right now. I don't really need the bearish delta right now. I like where my delta is based on the goals I've kind of set for myself. And it's like, all right, now you can start to see the plan coming together. So I would probably look for a strategy like a short strangle or maybe a short straddle. Now, I only have $20,000 in this account, so I have to be mindful of the types of stocks that I use. I can't really do too many undefined risk strategies in, really high price stocks. I mean, like Chipotle, IBM, Netflix, Microsoft, they're going to be way out of reach. It's probably going to have to be under $100 for me to be able to fit this strategy in my account. So maybe we sort my stock price here from, low to high. So now if I find a stock that's maybe, around 50, 60, $70. So if I'm looking at some of these stocks, you can see I've got EEM, the stock price is only 41. I've got Citigroup, the stock price is only 50. I've got EWW, the stock price is only 55. These would be great options for me to sell premium. Now, the elephant in the room here, if we go over to the right, you can see EEM, the IV rank is only 5.3. So IV rank, of course, measures implied volatility against itself for the last year. So this is very low. We would much prefer to see a number of 20, 30, 40, if not even higher. So that's very, very low. But again, the VIX is 18 or 19. I have to be aware of the context that I'm in. So I'm not necessarily going to dismiss it because it is so low, just with the understanding, again, that I don't want to allocate all my capital. And so EEM, Citigroup, EWW, you've got Cisco. Cisco's got an 11. You got GDXJ. Hey, how about GDXJ? This is a great option, right? It's got an IV rank of 18. The stock price is only 40. So it's going to be able to be, I can fit this into my account pretty easily. I click on GDXJ. I go to the trade page. Maybe I go into, February only has 32 days. Maybe I go into March. So I go into March. Again, you can see how I've kind of built this whole strategy from the ground up, right? Theta, undefined risk. Want it to be neutral because my delta is where I want it to be. And so now I've got the strategy selected before I even go into the trade page. Before I even look at any of the strikes, it's all already kind of settled in my mind. And now I'm going to fine tune it. Now I'm going to actually select the strikes that are going to make the most sense. And so what I typically do if I'm looking at something like a strangle is I'll just go right to the expected move. That's the copper strip you see here in the center. I go right to the expected move. I go just outside of the expected move. And let me start by seeing what kind of premium I can collect with that. So let's say I sell a 35 put and I sell a 46 call. So you can see very clearly, hopefully very clearly on the screen, I'm outside the expected move, right? I'm outside of what the market is expecting this stock to do for this cycle. You can see my pop is 68%. My P50 is 83%. My theta is 3.2. So you can see my theta from this one strategy alone, which of course I can't put it on now because the market is closed. But from this one strategy alone, my theta is going to jump from 5 to 8 or over 8. So that's a big, big change. The buying power effect is only $1,200, so I can fit that into my account. It's only about 6% of my account, so that's very, very good. And then the credit collected is 176. So I kind of got lucky in that I probably wouldn't change anything about this. I would probably send it as is and say, all right, that's a really good trade. It's neutral. It's undefined risk. It's a lot of positive data. It's in an index. I don't have to worry about earnings. I don't have to worry about these, individual stock events. And so I know that was kind of long, but hopefully that kind of gives your audience, a literal step-by-step for how I build strategies and new trades from the ground up.
Great, man. That's great. Well, by the way, we got a few questions in English here. Which is great.
Oh yeah, let's do it.
How's the learning curve of trading options? That's a good question, right?
It's a great question. That's a great question. So that's from Henrique. So
Henrique Gonzalez.
Yeah, is it Henrique or Henrique? Do you know?
Henrique.
Enrique, got it. So Enrique,
Yeah, that's right.
So it's the learning curve is very steep. Right? I'm not going to lie to you, Enrique. I'm not going to tell you something that's just not true. I'm not going to try to sell you on something that's just absolutely false. The learning curve is going to be steep. You are going to have to be committed to this. You are going to have to be dedicated to this. You are going to have to be ready to be confused, ready to be a little bit lost, ready to make some mistakes. You're not going to come out of the gates and just start, hitting home runs with your first couple of swings. It's just not going to happen. It's not realistic. Right? I mean, Junior's been doing this for, well over 10, 15 years. I've been doing this for, 20 years. And we've been doing this for a very, very long time. And so, we've made all the mistakes that you're going to make. Trust me, we've made all of them. And so just be ready that you are going to make mistakes. And so this is why, if you are a new trader, Enrique or anybody else, I strongly suggest that you start with, a little capital. It doesn't have to be a lot. I probably wouldn't start with any more than 20 or 25,000. 25,000 max. It could even be, 10,000 or 15,000. I would probably do mostly defined risk strategies in the beginning, vertical spreads, iron condors, etc. So that way, if you do make mistakes, or I guess I should say when you do make mistakes, because you are, then having that safety net in place is going to be really valuable for you. And so just be ready for that. It is going to happen. The learning curve is going to be steep. But this is where having people like Junior in your corner to lean on and to ask questions and to reach out to, having people like me in your corner reach out to me, man, ask me questions to help you get over the stumbling blocks and the sticking points. It can be really, really valuable, but it is going to be steep. But the rewards on the other side are so dramatic. So dramatic. If you want to trade options actively, if you just want to use them as kind of a supplement to your long stock portfolio, you can do that too. There's so much that you can do with options that you just can't do with straight stock.
And the same guy, he's got another question. Not a good question, actually. Look at that. How to set delta and theta goals.
Yep.
You
So that's a great
talked little
question.
bit about it, but if you want to go it.
No, definitely. No, let's do it. Yeah, because I kind of touched on that a little bit, and I was like, I kind of glossed over that. And I was like, should we get into this or not? This is a great question. I'm actually glad that you brought this up. So, okay, so a couple of things. So let's start with theta first, because theta is a little bit easier. I think that most traders are going to be somewhere between 1/10 of 1% of net lick and 0.5% of net lick. Now, I'll give you some actual examples to what those numbers mean because it can be difficult to work with. We're talking about fractions of a percent at this point. But 1/10 of 1% of net lick, 0.5% of net lick. So what that means is if you have $10,000, that means that on the low end, 1/10 of 1% of net lick is 10, 0.5% of net lick is 50. So you're probably going to be somewhere between 10 and 50. So I think most traders are going to be somewhere between 0.1% of net lick and 0.5% of net lick. Now, how do you determine whether you want to be on the lower end of that spectrum or the higher end of that spectrum? Well, I think it depends on a couple of things. I probably won't, I probably can't recall all the things that it depends on here in this moment, but here are a couple of the main things that it depends on. Number one, your tolerance for risk, your risk appetite. If you have a high tolerance for risk, if you are okay with big swings in your portfolio, if you are okay with big volatile moves in your profit loss, in your P&L, then being higher on that in that range is going to certainly be okay. So now you're at 0.3%, 0.4%, 0.5%, because the more theta that you have working for you, the more time decay is working for you in your portfolio. So the more the passage of time just works in your favor. Now, one of the most common questions that I receive, I get this question almost every single day, honestly. People are saying, Jim, wait a minute. Positive theta is good. Time decay is good. I want this working for me. Why should I cap this number? Why should I stop at 0.5%? Why shouldn't I just put as much theta in my portfolio as I can? It's a great question. And those types of questions I love getting those kinds of questions because it shows me that people are really thinking about this stuff critically. They're really putting the pieces together and they're really starting to figure it out. The answer to why you want to cap that at some level is very simple. Theta, as we just saw, you saw my strangle in the portfolio where we were able to collect $3 in theta. When you do strategies like iron condors and vertical spreads, they're great. They have a place, but they don't typically have a lot of theta. They only have a little bit of theta because you have to buy those wings. You have to add those long options to define that risk. Okay. If you want to build up big levels of theta in your portfolio, you're going to have to expose yourself to a lot of undefined risk. And of course, by definition, by the very nature of those strategies, you need to be ready for your portfolio to swing and whip around a lot because that's what undefined risk does. And so for some people, that's just way too much risk, right? I mean, 0.4%, 0.5%, it sounds great on paper, but you just have to be aware of what you are signing up for. And it's a very, very bumpy ride. So I think most people, if you're at 0.1%, that's very, very conservative. So 0.1% to 0.2% is pretty conservative. Now, I tend to be more conservative, so that's why I usually land somewhere between 0.1% to 0.2%. If you are less conservative, if you are more experienced, if you are ready for the bumps and you want to go after higher returns, then you would go to the higher end of that spectrum. So that's the theta side of things, Enrique. It's a great question. So let's talk about the delta side of things. So the delta side of things is a little bit more involved. So as if that wasn't involved enough, but this one's actually a little bit more involved. So if you have short delta, if you want to play the market from the short side, the tasty research has shown that a delta to theta ratio of 0.5 is a very good ratio to have. So for every 2 theta you have in your portfolio, you want to have 1 short delta. So you saw in my portfolio, I have 5 theta and 14 delta. So I have too many delta per theta. But again, the year just got started and I'm trying to, build the portfolio out to where I want it to be. So it's not exactly where I would want it to be. But a delta to theta ratio of 0.5 is a very, very good uh, relationship between theta and delta in terms of, your delta goals in your portfolio. If you carry long delta, however, it's a little bit more challenging. It's a little bit trickier to figure out. And so can you bring back my portfolio, Junior? Let me
Right
let me
now,
kind of
sir.
show this here. Yeah, let me show this here really quick. So if you have long delta, this is a little bit tricky. And I wish I had drawing tools, but I don't have any. Well, actually, wait a minute. Hold on a second. Let me see if I can do this. This might work actually. Oh, this will be great. Give me 2 seconds there, Junior. Let me try to
Oh, man,
get
no
my.
problem. Take your time.
Oh, I think I got it. Oh, that's great. Okay. Um, because if I can draw on the screen, this is gonna be awesome. So all right. So can you guys you can see that
You got
circle,
it.
right? Oh, that's great.
Yeah,
Okay, so
sure.
hold on, let me erase that. I don't need that. But this is gonna make this so much easier to follow. So all right, so now we have all this blank space down here, right? So let me go ahead and break out my little pen. So here we go. Okay. So if I look at SPY, right up there, it's about $400 a share. So this is perfect. Right? So SPY is 400. So right here I'll put 400. So if I held 100 shares of SPY, this would have a notional value of $40,000. Now you can see that my delta up here is minus 14. If I had a $40,000 account, so if now again, my account size is not 40,000, it's only 20,000. But if I had a $40,000 account and my beta weighted delta, that's what this number is right here. If my beta weighted delta was also equal to 100, then this portfolio right here would feel like 100 shares of SPY. They would basically be the same. They would basically feel the same. So in this situation, the way that I would classify this portfolio is you would have a leverage of what, well, let's not do it that way. You would have a leverage of 1x SPY. In other words, you would have a leverage of that's an arrow. You would have a leverage point of 1 to 1. So your portfolio at 100 beta weighted deltas is going to move a lot like 100 shares of SPY. So it's 1 for 1. Okay. Let's say that I have a $40,000 portfolio, but instead of having a beta weighted delta of 100, I have a beta weighted delta of 200. How does that change things? Well, remember that to feel like 100 shares of SPY, that's a $40,000 notional equivalent, which it happens to be the size of my portfolio. But my portfolio doesn't have 100 shares of SPY. It has what is going to feel like 200 shares of SPY. So, in other words, my portfolio is not 1 for 1. My portfolio is 2 for 1. So now all of a sudden, I have 2 times leverage the SPY. Now let's use another account size that's not exactly equal to $40,000 in SPY. Let's say you have a portfolio that is $60,000. So if I have a $60,000 portfolio, I have in my portfolio at an SPY price of 400, approximately 400, I have effectively the value of 150 shares of SPY. Now, how did I get that number? I just took 60,000 and I divided it by 400. My portfolio basically feels like 150 shares of SPY. Hopefully, this is kind of making some sense to you guys. So, how do I take this and convert it to some leverage relative to the SPY? And I'm going to tell you what to shoot for here in a second, but I want to work through all the math first. If in my $60,000 portfolio, I have 150, and again, these are all positive deltas. because I told you how to deal with negative deltas. So these are all positive deltas. If I have positive 150 beta weighted deltas, that's going to feel like a 1-for-1 ratio or leverage with SPY. Because again, my total value of my portfolio is already valued at 150 shares of SPY. So if I'm carrying 150 beta weighted deltas, that's 1-for-1. But what if I'm carrying 300 beta weighted deltas? That's 2-to-1. What if I'm carrying 450? That's 3-to-1, and so on and so forth. And then, of course, use this. I mean, screenshot this. I won't delete it for a couple of seconds. I would take a picture with your phone, and then you can use this to say, all right, I don't have 40,000. I don't have 60,000. But I firmly believe that if you sit with the math a little bit and go through the same steps that I did, you can convert this to any size portfolio. If you've got 10,000, if you've got 600,000, whatever it might be, you can use this to convert it. Now, what should your leverage point be? It's a great question. And again, it really comes down to your risk appetite. But I think for most people, I think 1x to 2x is a good level for most people. When you start getting above like 2x to 3x to 4x, man, that can be really hard to manage, especially if you're playing it from the long side, which is what we're doing here. Because remember, the big outlier moves that usually happen in the market, which direction do they usually go? Unfortunately, it's not up. It's usually down. And so when you're playing the market to the upside, you have a lot of things working for you. You have positive drift. You have short puts. You have all these things that can be really helpful and advantageous. But you don't want to put yourself in a position to where you're so leveraged that if the market does drop, 5% in a day, 7% in a day, that your whole strategy completely blows up because you're just too leveraged. So I think if you stay between 1x to 2x, most traders are going to be able to handle most situations that come their way, and they won't have to completely change what they're doing. Oh, I can't hear you.
Hey, man, great answer.
I got you.
Amazing.
Okay. Yeah,
Okay,
cool.
let me bring this one. Jim, can you talk a little bit about delta hedge? How often do you use it on a daily basis? I mean, it depends on directional exposure, but how do you work with that?
Yep, that's a great question. That's a really, really great question. I'll give you two answers. One of which, unfortunately, is kind of incomplete, but the second one is kind of how I handle on a daily basis. So let me go ahead. This is great that I've got my drawing tools up now. I'm going to use these a little bit more. So let me erase this. Hopefully everybody got a picture if they wanted to take a picture. Let me go ahead and erase all this though, so we can kind of start over. So I believe that the best. So when you think about hedging in the marketplace, right? I mean, there's so many different things that you can do, and you could buy puts, you could buy puts in SPY, you could buy calls in the VIX. I mean, there's so many things you could do, right? Well, the one thing that you have to keep in mind, every single hedge. Let me go ahead and get. All right, perfect. So every single hedge. Let me get my thing back. So every single hedge, which we'll call H, it all has a cost, which we will label C. Every single one. You will never find a hedge that is free. It does not exist. It does not exist. You're not going to find it. I don't care what the YouTubers say. I don't care what the internet says. It's not free. You're paying for it somewhere. Now you have to decide, where do you want to pay for whatever hedge that you might want to put on. So if I do, a long put in SPY, what is the main cost of that? My main cost of that, which again is C, is going to be equal to, in my opinion, the negative theta. So when you buy a put, and there are other costs too, but I think this is the main one, right? Just to kind of keep the discussion a little bit focused and simple. I think the main cost here is negative theta. You're going to have to hold that put. And every day that you are wrong, which is going to be a lot of days because the market wants to go higher or go nowhere or it doesn't crash or whatever, those options are just going to decay in value, right? It's all the reasons why we like to sell premium. We like to be on the other side of all of that. But sometimes if you want to hedge, you want to buy a put, that's fine. I have no problem with that whatsoever. You just have to understand that negative theta, man, it's going to be a real bear for you to overcome. So that's your main cost with a long put. Okay, what about a long call in the VIX? So I could also do that. What's my main cost with this? Well, it's sort of related to this. You also have negative theta, but I'm actually going to go in a slightly different direction. Volatility, just in general, it wants to contract. So volatility does not want to go higher. It does not want to increase. It does not want to expand. I mean, Junior, we kind of led the show off with this a couple minutes ago, talking about the VIX being at 18. Like nobody saw that coming. Everybody thought it was going to stay above 20. I didn't think it was going below 20 anytime soon. And here we are at 18. It might be 17 tomorrow. That's crazy. That's crazy. The volatility that's what it wants to do. That's the direction it's trying to go. That's the path of least resistance when it comes to volatility. So those are your costs. Okay. In my opinion, the best hedge, it's not this and it's not this. It's staying small with your position size. I really, really, really cannot express to you how valuable this is. How valuable this is with your options, how valuable this might be with your scalps if you're using futures or whatever. It is so valuable. It is so valuable because it just gives you so much flexibility and so much wiggle room and so many opportunities to do things later, to act objectively, to not get all emotionally charged up, and all of those things. Well, if you stay small, you might be wondering, well, what's the cost if you stay small? Is there a cost? Yes, there's always a cost. I just said that a couple of minutes ago. But what is the cost here? It's a little bit less obvious. And this is kind of what I do every single day. So, Arthur was asking me, how do I delta hedge every day? This is my overall hedging strategy. It's not necessarily a delta hedging strategy per se. And I'll talk about that here in just a second. It's more of an overall hedging strategy. By staying small with position sizing, it allows me to remain objective. It allows me to remain flexible. But what is the cost? The cost is larger returns. The cost is, because I'm so small with my position size, larger returns. That's an R. I'm giving up larger returns on the trades that are correct, on the trades that work for me. Because I'm small on entry, I don't make as much money. That's what I have to give up. But in my opinion, I will gladly give that up. I will gladly give that up to be able to handle a 4 standard deviation move against me, to be able to handle the market going down 8% in a day. Now, right now, I'm a little bit negative delta, so I'm kind of hoping that happens. But generally speaking, I play positive delta. And so what about delta hedging? Well, so I'm working on a couple of things behind the scenes. So I'm working on a couple of things behind the scenes that I'm kind of trying to iron out some kinks. It's come along. I've been working on this all year last year. It's been a project that I started at the beginning of last year. And I've ironed out a lot of kinks. I'm not ready to kind of make it publicly known yet. But there are some things that I'm working out from a hedging standpoint that might come online later on this year when I feel confident in their ability to hedge. And so I don't do a lot of delta hedging now, but it is something that I'm working on, Arthur. So, if you follow my content or follow From Theory to Practice or follow me on Twitter or, follow my YouTube channel or whatever, these are some things that you might see later on in the year.
And I'm sure that everyone is going to do it. Don't worry about it, Jim. Everyone is going to do it.
I appreciate you, man. That's great.
I always tell the guys, I always tell everyone, guys, do what they do. Trade small, trade often. That's what we got to do. That's all we got to do. Don't do crazy shit. Don't do crazy stuff. But I mean, it's going to work maybe once or twice. But when it goes against you, you're gonna get crazy. You sometimes you don't even know what to do because there's nothing to do. We're going to talk about it right now. When you talk about options trading, Jim, I mean, there's a difference between managing defined risk strategies and undefined risk strategies. And a lot of students in the beginning, they rely on put credit spreads, all right? Can you tell us how to manage this kind of strategy? I mean, put credit spread.
Yeah, absolutely. So let me erase all this. I'll go ahead and put one up here on the using my platform, and we'll kind of talk about it really quickly. So let me go ahead and let's grab that. So let's go into, rather than using like a market index, let's go into Tesla, and because now we're doing something that's defined risk. So now you can trade any stock you want to trade, right? I mean, the price doesn't really matter anymore because you can get as small as you need to get when it comes to that. So let me go ahead and let's go into the trade page. Now, Tesla has earnings coming up. Oh, wow. In just about a week or so. And so we would want to be mindful of that. But let's say that I go into, the March cycle and I want to do something in Tesla. I want to do something that's bullish in Tesla. And I want to sell a put spread in Tesla. So kind of a put credit spread like you were talking about there. So let's say that I sell a 115 and I buy a 110. So if you look right here, it's so nice to have my drawing tools up. So if you look right here, my credit is 195, right? My probability of profit is 54. My P50 is 71. Like everything is looking good. Okay. So how do I manage this strategy? What do I do? This is so simple. I'm going to give your audience the best possible answer that they will find anywhere on the internet. 19 times out of 20, 49 times out of 50, 99 times out of 100, you should do absolutely nothing. Nothing. I don't care if Tesla goes down. I don't care if Tesla, crashes through your strikes and you're like, I got to do something. No, don't do anything. Give the strategy a chance to work. Because remember, when you put this strategy on, the pop is 54, the P50 is 71. I mean, I can see it right now. That's not my opinion, right? I'm not making this up. You can see it on the screen yourself. So the probabilities are already in your favor. And those probabilities, they've already taken into account all the possible pathways of Tesla. Right now, that's not to say if Tesla goes down that it's going to come back up. I'm not saying that at all. It may stay down. You may end up with a max loss. You may have a losing trade. That's absolutely going to happen to you a time or two. But keep in mind, you've got 60 days to go on this trade. You've got a very, very, very long time to go on this trade. And so one of the most common mistakes that I see new traders make is they put on a trade like a vertical spread, which is a great trade to learn from. It's a great trade to get started with. I love it. I absolutely love it because, you can see right here, my max loss is 305. If Tesla does go down to 80 or whatever, you're only going to lose $300. It's not undefined risk. You don't have to worry about huge moves. Like your losses are capped. But one of the biggest mistakes that I see traders make on a regular basis is they have a strategy on like this and it gets tested and the stock goes through the strikes and they feel like they need to do something. Almost every single time, the answer to that is no, you don't need to do anything. You need to give it a chance to work. Don't close it early. Don't add things to it. Don't do anything. There's one exception to this, and I'll talk about that here in a second. But I really want to beat into the brains of your audience that they should practice doing nothing. It's actually a very hard skill to exercise. It is a very hard skill to get good at because you feel like you should do something. Like, man, I should be zigging. I should be zagging. I should be doing something. No. Save all that for your undefined risk strategies. Save all that for your strangles. Save all that for your short puts. Save all that for your scalps or whatever. Don't use that with defined risk. Most of the time, you should do nothing. Okay. Now, what is the one exception? The one exception is this. You see that the stock has 60 days to go. So I put this strategy on. Let's say tomorrow the markets are open. I put this strategy on and, I let it cook. I just let it cook. I let it sit. I let it do its thing. And let's say within the first couple of days or the first week, my strikes get tested and Tesla goes way down. I'm not going to do anything. I'm not going to do anything to that strategy until we get to around 21 days to go or so. If I get to around 21 days to go and I can highlight these strikes and I can roll them to the next cycle for a credit, then that is something that I might do. That is something that I would consider doing to give the time more trade or to give the trade more time. I'm not going to roll for a debit. I'm not going to change my strikes. If I can roll the same strikes for a credit, then that is the one thing that I will consider. If I can't, then I will just sit tight and just give it a chance to come back. And it might not come back, but it also might come back. And remember, when you put this trade on, the probabilities are in your favor. So I would absolutely remember that and take advantage of that.
Yeah, and a really good thing that I really want you to empathize about it is you never roll a trade for a debit. It doesn't exist. I mean, it's out of you put it. It doesn't work, right?
No, you don't want to do that because if you roll for a debit, what it does is so right here. Since we still have this on the screen, and here I'll grab a different color to kind of to emphasize this. Look at your max loss at $300, right? Let's say that I was going to roll this strategy forward and I was going to have to pay, and let me just write it. I'll write it down here. Let's say that I could roll it forward, but it was going to be a 20-cent debit. So let's say that I get to 21 days to go in the March cycle and I can roll it forward and I want to keep it on. But the only way I can do that is if I pay a 20-cent debit. Well, guess what just happened? That 20 cents it gets added to this maximum loss. So now it's not 325, it's 325. Now you might be saying, Jim, that's not that big of a difference. I want the more time. I want to give this thing a chance to come back. And you're right. It's not that big of a difference. And you're right. It will give it more time. But the other thing that will also be happening is you are building and establishing very, very bad habits. And so that is something that might become very hard to break later on. And so it's not worth it, in my opinion. I would not roll for a debit, because when you roll for a debit, you're adding risk to the trade on a defined risk strategy.
All right, so let's take another question here, Jim. A really good question. Can you read it? Get right?
Yep. Yeah, Flavio says, "What if I can't roll for a credit? Is it wrong to increase the spread of the strikes to get a credit?" Great question, Flavio, and that actually is kind of what I was just talking about a second ago. I kind of alluded to that. So let me see. So let me delete all this. Let me see if I can hold on a second. Let me see what my trades are right now. So if I go in here, what do I have again? I got EWZ, that's a strangle. So that's not going to work. I've got the Qs. That's a vertical spread, but that's not going to be a debit to roll. That's going to be a credit to roll. So let's see here. So I really wish I had one on. It would be the easiest way to show you guys. But let's see. So let's think about how we can do this. So if I go into, if I'm in February, let me go into, well, we can stay in Tesla. That's fine. Well, actually, I don't want to use Tesla because it has those weird strikes. Let me go into Amazon. So let's go into February. Okay, that's a little bit better. So let's say that I'm in Amazon and I put on this 95.90 short put spread. And let's say that I want to roll. So let's say, and again, guys, just bear with me for a second, because I got to kind of figure out how to do this, present this without having the current position on. So, okay, so I've got a $1.68 credit down here. Let's say that Amazon goes down. So Amazon fall, right now you can see it's at 98. Let's say that it falls down to, 88 or something like that. So now it's, it's somewhere around here. So what's going to happen is, if I want to roll out at the same strikes, so if I want to stay at, 90 and 95, most likely, because this option, or because this spread is in the money, because the stock is below my strikes, this is going to be, if I go to roll this, it's going to be a debit to roll. So one of the things that you can do to create a credit for yourself, and hopefully this makes sense to you, Flavio, as I try to work this out without having the position. One of the things that you could do is you could say, all right, what I'm going to do to create for myself a credit is I'm going to move. So I'm going to clear away. Let me clear away these drawings right here. So we've got this situation. Amazon has fallen down to 88 or whatever. I want to roll the strategy, but it's a debit to roll. Well, what I could do is I could go out to, March, because I was in February, right? And I had the 95.90. But one of the things you could consider is widening it out to 95.85. So if you just notice what just happened. So let's pay attention to this actually. So look at this credit. It'll be a little bit different if you roll it from one cycle to the next, but the same relationship is still going to be true. Just look at what happened. If I'm at 95.90, the credit is $1.75. Well, look at what happens if I widen it out. And I think this is kind of what you're getting at here, Flavio. If I roll this thing, if I roll that 90 strike down to 85, look at what happened to my credit. It just increased. So some of you are out there thinking, well, wait a minute, Jim, hold on a second. If I stay at the same strikes and I roll out, it might be a debit. But what if I roll out and then widen it out at the same time to create for myself a credit, which is exactly what you see happening here with the credit increasing. Except in that situation, it wouldn't be a credit changing from $1.75 to $3.05. It would be like a 20-cent debit changing to like a 40-cent credit or something like that. Why don't I consider that? The main reason is this. Remember that in the February cycle with this specific strategy that we're looking at, you had a $5 wide spread on. So your maximum loss was being determined by the spread having a maximum value of $5. If it stayed in the money and you had to buy it back at expiration, you would buy it back for $5. Well, if I have a spread that's $10 wide, so now all of a sudden I'm 85.95. Now, if the spread goes in the money and fully in the money, I'm not dealing with a $5 spread. Obviously, I'm dealing with a $10 spread. So if I have to buy this thing back at expiration, I'm not buying it back for $5. I might be buying it back for $10. So yes, maybe you were able to create for yourself, kind of muster up this credit on the roll, but you just added a ton more risk to the trade. So Flavio, this is why this is not usually something that we consider, because again, you would be increasing this maximum loss point potentially in a very significant way that you might not realize at first glance.
Great, man. Awesome. Jim, there's a question here. I don't even know if you know the answer because it's not about trading, but if you if
Oh,
you
I
if
love
you
those
know it,
questions. I love those questions.
no, but it's just asking about available in Canada. Do you know anything about it?
Ah, man, I keep hearing the same thing that y'all hear. I hear this. It should be soon. I know we've been saying that for 2 years, or 3 years, maybe longer. I don't know. I don't know the answer to that. I don't have like a specific date. If I had one, I would tell you guys. Obviously being part of Tasty, I am aware of conversations that happen and information. But for all I hear, Tom probably knows. He probably knows the date, but he hasn't told us, and so I don't know the exact date.
Yeah, that's I have a few students from Canada and they really want to play with Tasteworks. But anyways, so moving on. How do you play earnings? I know you're playing earnings right now, especially because volatility is too low, so it's kind of good to play earnings this times. But how do you play earnings, Jim?
Yeah, so I typically, like if you look at if we stay on here, we look at, Tesla has earnings coming up pretty soon. Wait a minute. Netflix, I think, is this week. Netflix might be on Wednesday. Let me
Yeah,
look and
Netflix is this
see.
week, Friday, I
Yeah,
guess,
Netflix.
something like that.
Yeah,
It's
there
on
it is right
Friday.
there. January 19th. No, so that's gonna be Thursday. It's on Thursday.
Yeah, Thursday. Yeah, that's right,
So yep,
Thursday.
so it's on
Yeah.
Thursday after the bell. So typically when I play earnings, like this Netflix trade that I will likely do something on Thursday, what I typically do is I use all the same strategies that I would use for a normal cycle. So the same process that I followed earlier, kind of showing you guys how I build the strategy from the ground up. I would do the same thing with earnings. It wouldn't really change in that regard. The only thing that would change a little bit is number one, I try to get even smaller with my position sizing because earnings can be so unpredictable, as everybody knows, that you really just need to be aware that you might be completely wrong. And you could have a big mover on your hands that you weren't quite expecting. And so for that reason, I typically shrink my size down even more. But then the other thing that I typically like to do most of the time is if I go to play Netflix earnings on Thursday, I'll probably use I'll probably use the March cycle here. So if we look at March, you've got March with 60 days to go. That's probably what I would use for Netflix earnings. I typically just use a regular cycle, same type of thing I would do for a normal trade, and I just use the earnings event as a bit of a kickstarter into that cycle. The only time that I might use like the front week, like so this week, which of course on Thursday would only have 1 day left to expiration, if I'm choosing a strategy that does well with very little time left. So a great example would be an expected move butterfly. So if I'm doing a butterfly strategy right at the expected move, which I'm sure some of your students are already familiar with, so I won't necessarily go over that, but that would be a good strategy that would work very well in the front week. And so usually I start with the normal monthly cycle, but from time to time I will go into that front week. And honestly, if some of your students are thinking, "Hey, I don't really want to mess with earnings. I don't really want to, deal with the big outlier moves." I have no problem with that. I've come in contact with a lot of traders that make their career only trading indexes. And so that's perfectly fine. I think that's a great way to approach the markets. I think you can be very, very successful doing that. You just have to be ready for periods of low volatility like this one. And so you just have to have a game plan ready for that.
Great, great. Now, there's a really good question that I want to ask you right now. In one of your videos, I heard you saying that when it comes to options trading, delta, theta, and vega are the three only ways to make money, right? Can you really explain a little bit to us about it?
That's a great question. That's a great question. And let's go back to our little board here. This is great. I like having this thing up here. This really helps me. It helps me supplement what I'm saying. So hopefully your students can grab a little bit more. So whenever I have an option position on, so I have an option position on. And you can see, well, actually right here, like look at EWZ, right? This is perfect for, my audience here today. So you can see I sold the strangle for $1.65. It's marking $1.62. So obviously it's basically at even right now. It's basically at a scratch right now. No money either way. But the thing to understand is that an option price, so this number right here, this option price can only be influenced by three things. It can only be influenced by direction, so some directional move. It can only be influenced by time, so time passing, and it can only be influenced by volatility, so volatility changing. These are the only three things that will move an options price. The only three. Now, I mean, when you look at a Black-Scholes option pricing model, it has a bunch of different variables, it has a bunch of different inputs. But if you actually look at those inputs, you will notice that all the inputs that go in there, they all funnel back to these three things and these three things only. These are the only things that are going to move an options price. Because like direction, this includes, the stock price. This includes, the strike price. The directional move is changing the relationship between those two variables. Time obviously is its own variable. And then you have, volatility, which, you have volatility changing, by way of Vega and things like that. And so we have direction, time, and volatility. And so I suppose you could say, well, what about dividends? I mean, what about interest rates? What about extrinsic values and things like that? But those play such a small role in terms of option pricing on a daily basis. That's why I've completely eliminated them from thinking about options in this way. I suppose technically we should include those things, but when it comes to trading the markets every single day, I never think about interest rates. I think about them in terms of the overall economy, but I don't think about them and, about my Tesla put. I'm like, man, I wonder what, the risk-free rate is and how it's going to impact my Tesla put. Like nobody that actually trades the markets thinks that way because interest rates are just really a non-factor on a day-to-day basis. So direction, time, and volatility. Well, if we look at, the Greek variables that control these, we have delta, we have theta, and we have vega. And so that's where, when you start to think about, your mark prices and how they change on a daily basis, where the position is profitable or it's not profitable or it's changing or whatever, you can always trace back, the changes in the option price to direction, time, and volatility. And so this can really help, when people are just learning the markets and trying to figure out what causes option prices to change. Don't focus on the minutia. Don't focus on, dividends and interest rates and all that stuff. Don't focus on that. Focus on direction, time, and volatility, and it's going to get you where you're trying to go.
Great, man. So, could you assure? I mean, could you say that the Greeks that you really care about are always delta and theta before putting on a trade? I mean, do
Yes,
you?
absolutely. Yes. And so I really only look at delta and theta on a daily basis. I don't even look at Vega, to be honest with you. I rarely look at Vega. Yeah, rarely look at gamma, right? Rarely look at these other. They're important. Like you need to understand what they're telling you. You need to understand, positive gamma, positive vega, negative gamma. Like I'm not saying to completely dismiss them and not learn about them and study them and understand them, but when it comes to making a trade, as you guys saw, 30 minutes ago, when I kind of walked through how I build a trade, I don't look at vega. I don't use the actual numerical value of vega to help me make a decision in terms of trade entry or trade exit or all the things in between. Because by looking at the theta itself gives me some indication of volatility exposure. It gives me some indication of, how much vega I might be exposed to in my portfolio. So, at a certain level, there's just you can't watch everything at a certain level, like I can't monitor every single thing, every single metric in the market. So I have to figure out what is the most important, what is going to give me the greatest benefit for the least amount of time and the least amount of resources that I have to invest. And it's going to be delta and theta.
Yeah, man, that's great. The same thing I really think about it when I think about charm, because charm is a Greek that I really like it. I know it's there, I know it exists, but I don't even know the number of the numerical value. Like you said, I don't even know it, and I don't want to know it, but I know it's there. And the first time I heard about charm was on 101. Option Greeks 101 that you made. And that was amazing, man. You were talking about Vanna, Voma, speed, color, charm, and I said, what the hell are you talking about, man? What are these Greeks? And after that, I was looking for it, and it's really interesting. And charm is one of the Greeks that I always care about. I mean, I don't know the numerical values, but it doesn't matter. But I know it's there, and I know it really happens, and it's
Mhm,
really great.
mhm. Yeah, no, that's a great example. Charm is a great example. I mean, the charm is always there. The charm is always working for you or against you, depending on whether or not you're selling premium and how far out of the money you might be. And by the way, for people that might be brand new or they've never heard of charm before, charm measures how your delta itself decays over time. So all the Greeks that we look at, delta, theta, vega, gamma, rho, whatever, they're all dynamic. They all change on a daily basis. Well, delta itself changes on a daily basis, and delta itself either gets stronger or weaker. It either moves closer to 100 or closer to zero as time goes by. And that's what charm is measuring. And I think it's a very, very important Greek for understanding, how delta itself changes just when time itself passes. And so, yes, I don't really think you need to know the actual numerical value of charm. I'm sure there are some traders that are very sophisticated and they have models built that are monitoring these values. And I'm very impressed by that. But I don't really necessarily think that we need to look at or monitor charm that closely to be successful. Having an understanding of what it's showing me, I think is plenty.
Yeah, it's like when they ask me about, oh, what's a good number for gamma? What I tell them is, all you need to know right now is out of the money options, low gamma, at the money options, high gamma, and in them deep in the money options, low gamma. That's all you need to know right now. It's gonna make that huge difference when you put on the trades, right?
Mhm. Yeah, that's exactly right. That's 100% right.
Yeah, let's go, man. So we know that in options market we have hundreds of strategies, right? So what can you say to anyone who's learning how to trade options? Should they care? Should they really care about all those names and different strategies? How do you handle with that?
Yeah, that's a great question. And so I think, you're right. There are so many different strategies that we could choose. There are so many different strategies that we could put on. I think that rather than trying to learn every strategy and rather than trying to learn all the strategies, which can be very exciting, right? Because you're like, I think I need to know all the strategies. I don't think so. I think if you just know 4 or 5 strategies and you learn them really, really well, then you're going to be pretty much ready for whatever the market might throw at you. Like you're going to be pretty much ready for anything that might come your way. And if people want to know what my personal list would be, it would be on the undefined risk side, it would be short puts, short strangles, and put ratio spreads. Those would be the 3 that I would learn and I would study and I would gain experience and I would try to master those. On the defined risk side, it would be vertical spreads, iron condors, and diagonal spreads. I think if you become really, really good at those 6 strategies, with a 7th strategy maybe being the standard covered call. I think covered calls are actually very, very good, especially for people that are just starting out and they're used to trading stocks. If you just learn those 6 or 7 strategies and invest all of your time in those, I really think that you'll be ready for any market environment that might come your way.
Hey, man, I think the same way, and I always tell them about it. You don't have to know all the names and all the things. You just have to know what to do with a few strategies that you got in your hands. That's all you need. Well,
Mhm.
and talking about it, speaking of which, for anyone who wants to build like a long-term portfolio over 15 years, do you think that options trading could improve the returns along the way? For example, the wheel strategy that they talk about it all the time.
Mhm. Yep. Yeah. So the wheel strategy, right? I mean, going back and forth between a short put and a covered call. I actually love that strategy. I love that strategy for somebody that maybe doesn't want to be super active every single day and just trading all day long. Maybe they don't want to, maybe they can't because of their life or in their work situation or their family situation, or there's so many different reasons why people might not have the time available to them to trade all day every day. And I totally respect that. But man, when it comes to long-term wealth accumulation, right? And looking out the next 15, 20, 25, 30 years, there are just things about options. I mean, we just talked about it, right? I mean, you can make money direction, time, and volatility, right? Those are the 3 different ways. if you have only stock, how are you going to make money? You're only going to make money from price and dividends. That's it. Those are your only two options, right? You can't make money from volatility. You can't make money from time. It's only price and dividends. That's it. And if the stock doesn't pay dividends, it's only price. And so that's good. That's fine. I'm a permeable too. Like I love it. But man, why don't you take that and layer on a whole new, world of strategy that's available to you where now you have time working for you. Now you have volatility working for you. And so when it comes to, if you think about your portfolio like a puzzle, right? You think about your portfolio like a bunch of different puzzle pieces. People that only use stock and people that only use like mutual funds or whatever, it's like they're trying to complete the puzzle without all the pieces. It's like they're trying to complete the whole puzzle and there's like 10 or 15 pieces that they can't find. And they're like, man, I want to get this thing done, but I keep missing out on this area that remains blank. Well, in my opinion, that area, it's options, it's futures, it's these derivative products that offer us things that you just can't access with stocks. And so that's why I love options just as a product. And I'm so excited to be able to help people, customize their portfolios. One thing, and this is a little bit off topic, but it's sort of related to what you asked. One of the things that really bothers me, Junior, is when I constantly hear people refer to the derivative space, options, futures, whatever, specifically options, but also futures. They always refer to it as automatically meaning high risk, as automatically meaning high leverage. And that's just so incomplete. That is so much of a misrepresentation of what you can do with derivatives. And it really bothers me because the average person hears that and they're like, "Oh, I'm not getting mixed up with that." And they hear all these crazy stories, these horror stories about, your Robinhood traders, your GameStop traders. I mean, all these things, they lost everything, they did this. And sadly, those things are real. Those things do happen. But what you also have to understand is there's a whole side to this that no one ever talks about. That I'm gonna shout this from the rooftops for as long as the good Lord gives me air in my lungs. You can use derivatives however you want to. You don't have to take a bunch of risk. You don't have to max out your leverage. You can actually remove risk from your portfolio. You can actually take down your leverage. Like I just showed you guys how to be, if you don't want one-to-one leverage with SPY, have, 1-to-2 leverage with SPY. You can easily do that. And so, yeah, and now you've got time volatility. I mean, there's just so much flexibility that it really bothers me when people completely dismiss options and futures. They don't really know what they're dismissing. And it's just, it's pretty, it's unfortunate in my opinion.
Well, I always tell everyone that options trading is like a toolbox. You know, you have to
Hmm.
open it and you have a lot of tools inside. And you can use it for different things. Depends on what you want to do. And that's it. But you have to know what to do with the tools inside the box because if you don't know it, nothing's going to happen. It's not going to be useful for you. So that's what I think. That's what I tell them all the time. You got to learn how to deal with that. And that's the perfect thing. I mean, that's the wonder about trading options, man. That's what I think. That's what I tell them every day.
So I love that analogy. I'm gonna borrow that if you don't mind. That's so good because you're
It's
exactly
yours, man.
right. It is a toolbox, and you've got to open it up, and you've got all these different tools inside, and you have to understand. Okay, I've got a certain project. I need my hammer. I've got a certain project. I need my wrench. I've got a certain project. I need my Allen wrench. I've got a certain project. I need whatever. And so that's exactly right. That's exactly how you should view it. I love that. That's great.
Yeah. Jim, unfortunately, we're getting to the end.
Okay.
Man, I really, really want to thank you again for being here with us. It was an amazing night. It was an amazing evening with you here. It was great. 1 hour 20 that I didn't even see it go so fast when you're talking about good things here, especially about trading options trading. But man, I really want to thank you again for your time. It's a pleasure for us. I'm sure that it's going to be really useful for all the students that are watching us right now. Listen, we got almost 100 people all the time watching us in English. We don't have subtitles right now. We don't have translations right now. So a lot of these students right now are watching us in English, trying to understand what we're talking about. And it's really great and it's really amazing because they really want to know what we are talking about. And in a few days, I think maybe 2 or 3 days, We're going to set the subtitles. We're going to make it the translations and everything that we have to do. And it's going to be really, really useful for them. So, man, I want to thank you for that. Thank you so much.
No, man, it's absolutely my pleasure. It's definitely my pleasure. And if people want to check out, more of my content, I mean, definitely check out From Theory to Practice on Tasty Live. But also, Junior, I'll drop my link to my YouTube channel. If I drop it can I drop it in the comments? I can put it in the private chat.
Sure.
I mean, I don't think I can make comments though. I put it in the private chat. Maybe you could drop it in the comments, so people could just easily find it.
All right, private chat. Found it. Let me find it.
Yeah, if you could drop that, just drop that in. Oh, there you go. Perfect. Yeah. So that's my own personal YouTube channel. I do all kinds of content. I do content on, finance. I do content on fitness. I do content on faith. So people can check that out. And then, yeah, definitely check out From Theory to Practice too, where, I talk about trading all day, every day. And you guys can connect with me on Twitter and Instagram too. And yeah, man, no, it was absolutely my pleasure. I really, really enjoyed this.
All right, man. I really hope seeing you in May in Atlanta. It's going to be like 5-hour driving away. Yeah, it's like 5-hour driving, right? Yeah, maybe around it. But I really want to see you there. I want to meet you there. Okay?
No, it's going to be great. I'll be there, and I'm looking forward to it.
All right, man. Thank you so much. Cool. God bless you.
All right. God bless you guys. We'll see you guys soon. Okay. Bye-bye.
Pessoal, bom, muito obrigado. A gente agora vai traduzir tudo isso que foi falado, tá? A gente vai botar as legendas, tudo certinho para que vocês possam assistir, beleza? E eu quero agradecer demais vocês que puderam ficar com a gente aqui até agora, que ficaram com a gente aqui até agora. Muito bacana. Obrigado pelo apoio, obrigado pelo suporte. E eu tenho certeza que esse material todo que foi feito aqui hoje vai ser de grande valia para todos vocês. Eu tenho certeza que depois de vocês verem tudo certinho com a legenda, quem conseguiu entender viu que o material é muito valioso. O que ele falou para a gente aqui é de grande valia. E eu tenho certeza que vocês vão fazer bom usufruto desse material. É o que a gente tenta trazer para vocês aqui o tempo todo. Beleza? Pessoal, muito obrigado pela participação de todos vocês. Um abraço e nos vemos no topo. Tchau, tchau, galera.